Good evening, everyone. I hope you're all doing great. I am CA Manobhar Verma back at your service, friends. We resume today's session. Where we left, we had a very interesting knowledge absorbing session where you all participated wonderfully with the good responses and regular query discussions on cost of capital. So today is part two of the cost of capital. I can see a lot of excitement already. So good evening, all the friends, all the students. I'm sure you could spend some time after the lecture in studying whatever we covered. We discussed each and individual component of the cost of capital. So a couple of students are a little bit concerned about they are not able to cope up. I believe you guys need to realize that yes, after the session, it becomes very important for you guys to go back, read that again, and then you will feel better. Right. So otherwise, I'm pretty sure those of you who are studying parallelly are finding these sessions useful because, of course, this requires a backup plan in terms of, okay, if you're studying a review class, follow it with practice, follow it with the self-study. So that's very important, right? So couple of things. I'm looking at a couple of queries right now. So Darshan says, when calculating the cost of debt, does the approximation method and YTM? Okay. Darshan, to be very honest, when we're talking about approximation method, we are looking at, redeemable debentures where we are actually spreading the cost, over the time period. Whereas when you're talking about the YTM, you might see fractionally different in terms of the rounding of numbers. Reason being is that when we're talking about a YTM, we are talking about an IRR specifically where the NPV is 0, right? So that is the rate. Whereas in the the approximation method, we are just exactly dividing the identifiable cost. We are not worrying about the discounting here over the life of the debentures. So I would not say that it may be exactly the same. What is important is that you need to follow what is being asked, and they will be specifying which method you are supposed to follow. Okay, then there was a question in capital asset pricing model from Himanshu. This is the systematic risk is considered instead of unsystematic risk as an investor putting his money in a particular company. So the risk attached to that particular company should also be no. Okay. So Himanshu, when you're talking about cost of capital in terms of the risk element in terms of cost of equity, try to understand. I think your query itself has an answer that, if you were able to cover up your risk by probably investing somewhere else, that is a diversifiable risk. Hence, that is not a relevant aspect in for you to decide what are they expecting. Are you getting me? Because remember, the cost of capital is anyways considered with respect to the expectations by the investor. So when we're looking at the cost of equity using the CAPM model, we are focusing on the systematic risk that is non-diversifiable, because that risk element would be there in whatever company or competitor the investor may invest in. Himanshu, I hope that helps. Bhumika, I will, if time permits, I will look at that later because I want to just cover up some practice questions first. I think you have a question in some example, right? Okay, if that question is related to your YTM method, you can take the random rates. I think that's what I told. Okay. Mohit, unfortunately, we will be using the standard language over here because many students do not understand Hindi. I hope you understand. Okay, so having said that, guys, I hope you guys remember what we did in the last class, and specifically talking about, we looked at the individual cost of capital components. We talked about the cost of debt, redeemable, irredeemable, right? So Bhumika, this is what I'm talking about now, that you need a two NPVs, positive and negative. So the second rate will depend on the first rate, whether it is a negative NPV or positive NPV. Himanshu says higher risk company in the same industry, the investor, that company expect higher return. Okay, So, Himanshu, but then again, we are talking about the particular company from a perspective of expectations, right? So risk-free rate and market rate would anyways be taking care of that part. Mind you, there is a risk premium also. So that part is anyways considered by risk premium. If you're talking about that company may have, again, the idea is that generally within the same industry, under extraordinary circumstances only you can consider that. Otherwise, most of the risk parameters could be impacting the entire industry, and that is why we are using the non-diversifiable risk. But don't worry that you need to understand that there is a risk premium element anyways, right? So that is also taking care of the factor which you are asking me. Okay. So coming back, so we discuss each and every component: cost of debt, cost of preference shares, cost of equity, cost of retained earning. Now, in the cost of retained earning, remember we discussed it is generally equal to cost of equity, whereas if it is a new equity to be raised, then it is different because of the flotation cost. And we also discussed a formula with the tax impact as well. Now, today we have to focus on the weighted average cost of capital. But I think before that, let's do one thing. We promised that probably we will start with a couple of MCQs here, right? So on your screen, guys, first couple of questions for the day, question number 3 and 4. And I request you guys to kindly mention the question number with your answers. Question number 3 and 4 on your screen. Okay, I've just got one answer till now. Okay, for question number 3, I'm getting two different answers, right? Some people are saying D, some people are saying C, some people are also saying A. Yes, the question is which of the following statements are false? Retained earnings do not involve any cost. Yes, they do. That definitely this is false. Weighted average cost is the sum total of cost of capital from various sources. I have a problem in this word. Sum total. The word is weighted average, so you have to apply the weights first. Hence, this is also false. Tax shield on preference dividend reduces the cost of capital. How come there is a tax shield on the preference dividends? These are dividends are appropriations against profit. And hence, this is also false. And thereby, the answer is B. Guys, I hope everyone got it. Okay, then we move to question number 4, guys. I already received some answers. Now, some people are giving me A. Most of the people are giving me A actually. Some people are also giving me C or D. Varsha, can you please double check your own setting also? I believe everyone can see the screen, right? Okay, so for question number 4, I'm getting some different answers. I'm getting like A, I'm getting B, I'm also getting C. Okay, in fact, one student also said D. So all the 4 options are there. Interest on government bonds. So by the way, answer for that question lies in our security market line graph. We discussed this specifically towards the end of the last lecture, that when it comes to the government bonds, these are the ones which are considered as a risk-free rate of return, and hence, so correct answer over there would be option number A. So I hope those of you said other options, probably missed out that point. beta of the stock is not the interest in government bonds, risk premium definitely not, and not even the market rate of return. So that's the risk-free rate, guys. Everyone clear, guys? Fourth A, third D. Everyone clear on these two questions now? Please confirm. Great. Now we talk about the main agenda of the day. Of all the efforts we have done on day before yesterday's lecture, we are just starting the weighted average cost of capital here. In fact, anyone else who joined slightly late, don't worry. We just did a couple of MCQs and now we are starting with weighted average cost of capital. Now, as the name suggests, it's the overall cost. Is the overall cost, right? From whatever source we're talking about. Equity, debt, preference, equity, including retained earnings. Now what we do is, Darshan, yes, I would say that if you very well know that if something happens to the government, probably you can't expect anything to be remaining, right? So that's something, that's why we consider them as a risk-free. I would not comment on who 100%, right? So, but if something has to be risk-free, that has to be government securities, right? So overall cost of capital is again from all the sources. And how do we calculate? We will apply the weights to each component based on its proportion to the total capital. So we're saying weights are applied to each component based on its proportion to the total capital and then multiplied by whatever we have done. So for example, we are talking about three sources of capital. Let's say weight 1 is for cost of debt. We're talking about weight 2 is cost of equity. And let's say weight 3 is into cost of preference shares. So we apply the weights, we multiply to the individual cost component, and then we add. That's the weighted average cost of capital, guys. You can see the formula here. Whereas in the last particular question, we were talking about in question number 3, there is a second option, weighted average cost is sum total of cost of capital. No, we're not even talking about sum total. We're talking about first applying the weights and then adding that up. Right now, the interesting point would be how come we calculate what is the primary perspective from perspective of looking at the weights of individual components. How do we calculate weights? Now, weights can either be used from perspective of the book value of individual components, as in whatever is the book value. Other way around is, so one is your book value, or other way around is the market value. Now, it can be as easy as it is said. Just one thing to be careful about when we are talking about market value, guys. Specifically, you guys understand that in a market, we are generally talking about market value of equity. So what do you think, guys? You always hear that, okay, what is the market price of the share of the company? Have you ever heard what is the market price of the equity of the company? Or market price of retained earnings of the company? Have you ever heard about that? I believe we always hear that, okay, what's the market price of the share, which is part of the equity? Do you agree with me? So let's see the responses. So we never say that, okay, there is a market value separately for retained earnings. So what I'm trying to say here is that for retained earnings, the market value of equity itself is said to be consisting of both equity and of the shares and the retained earnings. Hence, if you are using the market value of the equity, that could be proportioned basis the book values of share capital and retained earnings. So let's say as an example, you have a share capital of 500, you have a retained earning of 100. And we say that the market value of equity is, let's say, 900. Now, this 900 could consist of both equity and retained earnings, the share capital and the retained earnings, right? So equity, share capital and retained earnings. So we can use that ratio of book value 5:1. So this consists of 750 equity and 150 retained earnings. If we were to use the market value. Now, it really may not make a difference as such where the cost of equity and cost of retained earnings is same, right? Because there you can easily even use 600 as a common weight, but since it is advisable to have separate weights for all the components, whether it is debt, equity, or preference shares, or even retained earnings. So guys, I hope this is clear to everyone. So we generally take a book value, but when we take market value, you need to understand that market value is for equity, and for the retained earnings, you have to apportion that, kind of allocate that basis the proportion of book values of the equity and the retained earnings. So I want to just quickly check the query panel if in case there is everyone is on the same page. Now the exception or the extra point which I just said, that's also mentioned at the bottom here. So although there is no separate market for retained earnings, so the market value of equity includes both paid up capital and retained earnings. And however, cost of capital of equity or retained earnings may not be same because of the flotation cost, specifically in case of new issue. Hence, so the market value weights will absolutely have to be apportioned between the two, equity and retained earnings, based on their book values, because cost of equity and cost of retained earnings may be different in case of new issue. But where it is same, you may not go for a split, right? If it is same. If you're talking about like, okay, cost of equity is cost of retained earnings, probably you could use the same weight, which is combined, right? Rather than splitting into the retained earnings or share capital. But yeah, advisable is to split. Okay, so that's one piece. Let's focus on an example here, guys. A very, very basic example though, which talks about of the weights specifically. So there are a couple of questions. Okay, so a couple of questions coming in. One is, what is retained earnings? Suraj, retained earnings. So the portion of the profits that gets accumulated, retained in the business for the purpose of expansion and not given to the shareholders as dividend, that is retained earnings. Look at the terminology. Earnings that are retained is retained earnings. Okay, so Sudhanshu is saying, sir, when market value of equity is 750, why share capital value is 5? Okay, but Sudhanshu, on the top, I was talking about the book value here. Let me mention that. Those were the book value, the balance sheet values. Market value may be different. So Sudhanshu, is it clear? I hope everyone okay now. Can wait for a minute if any doubts so far. Okay. Great. So let's look at this example, guys. Cost of equity of a company is 10.41%, while the cost of retained earnings is 10%. So look at this. They have a cost of equity separate, cost of retained earnings separate. There are 50,000 shares of 10 each and retained earnings of 15 lakhs. The market price per share is 50, guys. So what is my total book value, guys? 50,000 into 10 is 5 lakhs, 5 lakhs and 15 lakhs. Equity retained earnings. So what is my book value? 5 lakhs, 15 lakhs. So that means we're looking at a ratio of 1:3, 5:15, and we're looking at the market price per share is 50. So that means 50 into 50,000. So we are looking at a 25 lakhs here. Everyone okay, guys, here? So we're looking at 25 lakhs. That means that 25 lakhs will be apportioned into which ratio, guys? Can anyone tell me? Let me wait for your responses. What is the ratio where we can split this 25 lakhs? Let me see the responses. So I'm getting 1:3 because 5:15 lakhs is the book value. Okay. So 1:3. Perfect. Everyone is like 1:3. So 1:3 means we're looking at 25 lakhs into 1/4 and 25 lakhs into 3/4. That means we're looking at 6.25 and 18.75 guys. And since we had individual cost of capital at 10.41 and 10, so that weight is being used here. And hence the WACC from the perspective of equity shares and retained earnings is 10.10. Yes, everyone okay here? Can you please confirm? Great. Anyone else wanted to ask anything, guys? Okay, so let's move on. We're looking at next is your a comprehensive question where we're looking at calculating of a WACC using a book value and market value as a weight. We're looking at both book value and market value. So capital structure of a company consists of the 5 lakhs debentures with market price is also given. Okay, one more question coming in from the Dikshita from the last example. Dikshita, the weights were based on the book value, na? That's what I explained. Look at the top book value given in the question also. 50,000 shares into 10, 5 lakhs is equity. Retained earnings is 15 lakhs. So that is the ratio. 5:15. That's 1:3, please. Sayed, cost of capital, cost of equity and cost of retained earnings is given to you, na? 10.41 and 10%. So we just applied those weights to calculate the weighted average cost in perspective of only retained earnings and equity. Do not worry. Right now, do not worry, guys. Please, we will be talking about again. Okay. Again, I'm getting a question from Mohit, how B is calculated. Mohit, please read the first line of the question. The first line of the question, it is given to you. And how do we calculate those? Please refer to the the lecture day before. We had already discussed what is cost of equity, what is cost of retained earnings. We had discussed 5 different methods. So you have to refer to the previous session for the same. Okay. Yeah. Coming back to this question, calculate the WACC using a book value and market value as weights. So the capital structure is given 5 lakhs debentures with market price of 105, 5 lakh preference shares with market price 110, equity shares of 10 lakhs with market price 24. Additional information is given 100 per debenture redeemable at par, 10% coupon rate, 4% flotation cost, and 10-year maturity. And same information is given for preference shares, equity shares. And they're saying that next year, the expected dividend is an annual growth of 5%. The firm has practice of paying all earnings in the form of dividend. Corporate tax rate is 30%, and we are specifically instructed, look at this, use the YTM method to calculate the cost of debentures and preference shares, guys. So YTM method question it is. Hence, we're first focusing on the calculation of cost of equity, which is okay based on the information. Can anyone tell me what will be the cost of equity? What will be the cost of equity? How do we calculate that? I think we can use the dividend growth model. So just waiting for responses. What will be the cost of equity here? Let's see who is the first one to respond. Okay, people are saying 10%, some people are saying 9.11%. That means it's something different with everyone's approach. Okay, so guys, let me just break the ice here. Some people are saying 10%, some people are saying 9.1%. My question is, if you are using the formula D1 upon P0 plus G, what will be my D1, guys? Remember that telling you next year's dividend is 1. Next year's dividend is 1. So D1 is already given. Can we do not further multiply that with 1 plus G? So hence it will be 1 upon. Now in this case, what would be the denominator, guys? They're giving you a flotation cost as well and market price. So 24 minus 4 is 20, and then growth rate is 0.5%. That is your cost of equity seems to be 10% here. Seems to be 10%. I hope everyone okay. Okay, now next is we have to calculate cost of debt using YTM method, guys. Cost of debt, YTM method. So hence, my question first of all is, what will be my annual cash flows? Initially, if you're looking at a 100 per day debenture redeemable at par, 10% coupon rate, 4% flotation cost. So what do you think, guys? In terms of debentures, what will be my initial cash outflow or cash inflow? You know, cash outflow from an investor perspective, cash inflow from the company perspective. What would be the initial one? Can we say, since we're talking about the existing debt, 105 minus 4%? What do you think? 105 minus 4% is 100.8. That's the initial cash flow. And then over the period of the bond, we are also looking at the interest post-tax benefit. I want to be pretty much sure that everyone understands this. I'm specifically focusing on right now on the cash flow problem. The cash flow column should be clear to everyone. So we're looking at a 105 minus flotation cost. That gives 100.8. And since we have our interest rate given to us 10% and there is a tax rate also. So 10, 1 minus 0.3. So we're looking at a 7 as an interest. And of course, the redemption value is a 100. So, Varsha, yes. So we are talking about the existing debt. That's why we are using that market price. Guys, I hope everyone makes sense for this one. And mind you, we are specifically told that we are looking at the YTM method, right? Great. So now moving on, we are also talking about that we are needing two NPVs because see, YTM method, we are anyways talking about the IRR here, right? So let's say first we discounted all the cash flows at 5%. And what do I get? If I discount all the cash flows at 5%, I'm getting 14.64 as NPV. I'm just giving 1 minute to everyone just to ensure that you guys are on the same page. I want everyone to double check if you are fine with a NPV at 5% here. Just let me know if you guys are fine with the 5% calculation, please. So minus 100.8, it is discounted at the current value multiplied by 1, interest multiplied by the annuity factor. Then we are looking at a maturity or the redemption value is also multiplied by the one last discounting factor. Varsha, you need to just check. Just check what is not clear. Let me know if there is a specific doubt. If you have not attended or you have not gone through, if not attended the previous session or not gone through the individual cost components, then it could be slightly a problem till you look at the YTM method first. To understand this question, there is a pre-requirement that you know YTM method. Syed, you can take any rate you want randomly also, right? So we have taken 5% and I got a positive NPV. So at 5%, I'm getting positive NPV. Hence, for a negative NPV, the second rate will be higher than 5%. And hence, we are taking 7%. So Danshu, I already told you in the last class, while we are calculating the IRR, we take initially we take outflows and we take inflows later on. That's why we swap the signs. And you will understand that in capital budgeting or investment decisions also. This is what I answered in the last class. So we are swapping the signs. Initial inflow becomes outflow, or you can think from an investor perspective. Investor, this is a outflow anyways, right? Okay, now we move on to the discounting by 7%. So at 7%, we get a negative NPV, guys. Negative NPV. Please check just once. If you guys are clear. Specifically, the discounting factors, don't worry about that. They will be given to you anyways. So we are looking at 14.64 as a positive NPV. And then we're also looking at a negative NPV here. And hence we apply the same IRR formula, lower your lower rate plus NPV at lower rate upon NPV lower minus high rate. Remember, I told you that be careful of the formula's denominator, which will anyways have a minus in that. That means denominator will look like 14.64 minus in the bracket. We are looking at minus 0.8. So this is what my denominator is. Hence, your denominator will automatically convert into an addition sign because it's minus minus plus. And we multiply with the rate differential to get an IRR of 6.9. Guys, very interestingly, let's say again I draw number 9, which I did on Wednesday also. Let's say at a 5% I'm getting an NPV of 14.64. At a 7% I'm getting a minus 0.8. With the naked eye also. Yeah, Darshan, but yes, I think that is something you should take a call. Let's say, so Darshan is asking a very interesting question that if we get a positive NPV at 7%, should we calculate another NPV? Ideally, yes, you don't have a choice, but my answer also would be what margin or what gaps you should have is dependent on what kind of a positive or negative NPV first is calculated. So for example, if I'm getting, let's say, a positive NPV of 100, 200, 500, then I would have taken straight away 10% as a second rate. But here it was just 14.64, so I calculated 7%. And my question here is that if at 5% NPV is at 14.64, at 7% is minus 0.8, can you tell me, guys, because IRR is the rate at which NPV is 0, so will the IRR be closer to 5% or 7%? Because on the left hand side you have 14.64, on the right hand side is minus 0.8. Even if we divide this line into various sequential numbers, we very well know that we are right here. We are just around the corner of 7% because we are getting a minus 0.8, which is as good as 0, almost there. So it's slightly lesser than 7 rather than more than 5. It is slightly lesser than 7 because it is almost 0 at that end. Had my let's say my present value, guys, let's say my present value at 7% was minus 15. Minus 15, guys. If my present value at 7% was minus 15, my IRR would have been right in between 5 and 7, would have been 6. Are you getting me, guys? The concept? I hope it is clear to all of you. Let me check the query panel first. Great. Similarly, can we also do a cost of preference shares using YTM? Now, what is the preference share scenario? We are looking at a preference shares as a market price of 110 and 2% flotation cost. So we're looking at 110 minus 2%. This looks to be a 107.8. 107.8, and since it's a 5% coupon rate, there is a dividend of 5, and mind you, no tax benefit is there for preference dividend. Guys, I hope everyone doing good till this point. What did in this case is, interestingly, and I think probably you might realize also that in this case, at 5% it's itself, I'm getting a negative NPV, and hence I'm forced to select a lower rate. So I've taken second rate as 3%, which gives me a 9.26 NPV. Right now, I'm not focusing on this calculation, that you can check later on. We have already discussed cost of debt. So you guys can check this preference shares example later on. But what I'm trying to say is that by naked eye also, you guys can say that, okay, at and let's say 5% it's minus 7.8. At 3% it is plus 9.26. It's probably somewhere in between, 5 and 3. It's like 4, right? So it's like marginally 4 and above, 4.09. So guys, we have calculated the cost of equity. We have calculated cost of debt, cost of preference shares. What's next? The requirement was, look at the top. Requirement was calculate the WACC using book value and market value weights. Now what's the book value, guys? Debentures 5 lakhs, preference shares 5 lakhs, and equity shares 10 lakhs. Amazing. 5, 5, 10. So looking at like 1:1, 1:2. So 1/4, 1/4, half. And that's what we are doing using the book values. So 5, 5, 10. Similarly, if we were to take market values with, that's also given to us, na? The market price is given to us. So what is the market price for the debenture here? I think we're looking at 525,000. What is the market price for preference shares? $550. What is the market price for equity? Are we looking at 24 lakhs? Hence, are we looking at 34.75 lakhs, guys? 34,75,000. Can I get a quick confirmation for everyone in the query panel if everything is good to this point? I'm just giving everyone 1 minute to digest the same. 1 minute to digest the same, please. I hope everyone okay with the weights part. Okay, so I can see a lot of confirmation. One student telling me that we are looking at equity at 10 lakhs. But we're looking at market value, right? So market value 10 lakhs. So book value is 10, market value is 24. So the market value has to be 24 lakhs, na? I hope all good, all in control. Great. So now we can move on to the very, very important point, which talks about marginal cost of capital, guys. Marginal cost of capital. Now what is this? Marginal cost of capital, as the name suggests, is the cost of raising an additional rupee of capital. Additional rupee of capital. So let me tell you what will happen is, generally, company will be always, any corporate will focus on minimizing the cost of capital. That's what I explained you guys on Wednesday. The cost of capital will be minimized. So generally, the capital structure will be decided in such a proportion which could result in a minimum cost of capital, and hence we will be focusing on some kind of a predetermined proportion of the capital structure. We also call it as a intended financing proportion. Any organization would want to maintain some specific proportion between debt and equity or preference shares or whatever. Now that means if there is an additional investment requirement, in a particular company's expansion plan, and they want to probably go ahead with, let's say, reinvestment of some retained earnings, do you all agree that in certain point of time, my requirement for going for additional equity may not be there? Because if I already have a retained earnings, why would I go for additional equity? Let's say, let me take an example. Existing capital structure. So what is existing capital structure? Let's say I have a equity of 200. I have a retained earnings of 100. I have a debt of probably, we're looking at, in this case, 150. So what we need to understand here is, I have a specific proportion, right? Let's say if a company wants to invest in a new project, which needs 120. That means 100 can come it from the retained earnings itself, yes or no? 100 can come from the retained earnings itself. Now, if I had to maintain the same proportion between the equity and debt, I may not be even requiring entire 100. I may be raising some additional debt also, and some part can be coming in from the retained earnings. That's what my intention would be. However, if the investment is required at a larger extent, you may have to go for an additional equity, to be raised as well, new share capital issue. And whenever there is a new share capital issue, we all understand there is a flotation cost. See, the idea what I'm trying to tell here is that marginal cost of capital can come into place whenever an organization is in need of raising fresh equity from the market. Fresh equity from the market. If we were to only use our retained earnings because we want to just maintain that capital structure or that proportion, then probably we're not even worried about. Till that point, the marginal cost of capital would be nothing but my weighted average cost of capital. Guys, are you with me on this? It's a very, very interesting concept, guys. We just need to understand this logically. I also want to ensure that, okay, you guys are pretty much onto it, because this will be something which can be requiring some knowledge absorption, and I want everyone to be on the same page. Quick confirmation from everyone, guys. What we are talking about here is this particular point. When a firm raises the funds in a proportional manner and the components cost remains unchanged, there will be no difference between average cost and the marginal cost. So till that point where we are going for additional equity, we're only using the retained earnings. There is no additional requirement, guys. There is no additional requirement. There will be retained earnings to be utilized, and hence that would just mean that there is no additional cost, because the cost of equity and cost of retained earnings at that point is same, mind you. But if you are going for a fresh equity, a flotation cost comes into the picture. The cost of equity is higher, hence the marginal cost will be higher, guys. Marginal cost will be higher, right? So let us do one thing. For this particular purpose, let us quickly look at a comprehensive example, and I'm pretty sure you will understand the concept much better, right? So let's go from here. I hope guys you can see a comprehensive example on my screen right now. Great. Let's focus this. And I want everyone to be with me on this. So Dhamaka Limited has the following capital structure, which is considered to be optimum as on 31st March 2019. So we are talking about 14% debentures, 11% preference shares, equity shares. Company share has a market price of 23.6. So this could be important. Next year expected dividend per share is 50% of the 2019 EPS. Following is the trend of EPS for the last 10 years. Just why this is important for us? Following is the trend of EPS for preceding 10 years. Why this could be important? Can anyone tell me? For the last 10 years, we're given EPS. What do we do for this? Bhumika says growth rate. Darshan says current EPS. Yes, so we'll be using everything, right? We'll be using both the aspects. So if you see carefully, guys, over the last 10 years, can you see some growth rate here? 1 to 1.1, 1.1 to 1.21. So these are EPS, 1.21 to 1.33. Look at the recent years also. 1.61 plus 10%, 1.77 plus 10%. So all the years EPS are going by 10% marginal increase. So can we say my growth rate is 10%, guys? Right? So let's say the company issued new debentures carrying 16% rate of interest, and the current market price of the debenture is 96. Preference share 9.2 with an annual dividend of 1.1 were also issued. And the company is in 50% tax bracket. So we have to calculate after tax cost of new debt, cost of new preference shares, and new equity share, assuming the new equity from retained earnings. Amazing. So let's target this question one by one. There are various parts. I'm just focusing on point A first. So this kind of covers up our weighted average concept also, and it also covers up a concept of marginal cost of capital. So I'm kind of taking you guys slowly one by one. So what will be my cost of new debt, guys, after tax? So I think we have a 16% rate, right? So 16% into 1 minus tax, 0.5. We are looking at 96, guys, 96 and denominator. So what is cost of debt? 8 divided by 96. Is it 8.33? Can you guys please check? Okay, everyone's getting 8.33. Great. What will be the cost of new preference shares? I think that would be the most simple one because of my dividend of 1.1 upon 9.2, there is no tax benefit, please. So 1.1. I think we're getting 11.96. Or if needed, we can mention it as a round of 12%. Now, the next one is new equity shares, assuming that it is kind of the new equity from retained earnings. That means we're not even talking about right now. From retained earnings means existing equity. So we are not even talking about flotation cost as of now. Hence, we say that cost of equity is equal to. Do we have D1 here? They said that next year dividend is 50% of 2019 EPS. 2019 EPS ka 50% will get 1.18. That's the next year dividend, guys. So 1.18. And do we have an equity price somewhere? Yes. The market price is 23.6. And plus 0.10, 10%. So who will tell me what are we calculating here? Cost of equity 1.18 divided by 23.6. I think that's 5% plus 10%. Are we getting 15% here? 15%, guys? Please confirm. Okay, great. Now look at the question number B here. Let's talk about question number B. Okay. For question number B, the requirement is the marginal cost of capital when no new shares are issued, guys. And that's interesting. We are saying marginal cost of capital when no new shares are issued. That means, so we are looking at, in this case, KR is equal to KE, and hence no new shares are issued. That means there is no marginal cost of capital. Can we say for point number B, that means that marginal cost of capital would equal be a WACC because no new shares are issued? Yes or no? All okay? And do we have the weights here? Yes, we have in the question itself. We have a 14% debentures, 30,000. We're talking about 11% debentures, 10,000, and equity shares, 1,60,000. Everyone with me on this? So what will be my WACC in this case? We are looking at a cost of debt 8.33 multiplied by 3 by 20 plus 11.96 or 12, whatever you got, into 1 by 20 plus 15 into 16 by 20. So what is my WACC, guys? What is my WACC? Quickly. Yeah, you can take 11.96. I'm fine. 8.33 So we are getting at, I think I am getting 13.85%, guys. Is it the same? You guys are getting 13.85%. See, we need to understand here there is no marginal cost of capital. It's same as WACC because no new equity shares are issued. Marginal cost concept arises when there is a additional shares because there the cost of equity will go up. That's a marginal cost. Cost for raising additional share capital, additional rupee of capital. Guys, I hope everyone is getting 13.85. Himanshu, thanks for confirming. What about others? Great. So everyone got 13.85. Dikshita and Sudhanshu, Gudri, and I think everyone is getting the same answers. Great. Now look at the third point, guys. Question number C. Determine the amount that can be spent for capital investment before new shares must be sold, assuming that retained earnings for the next year's investment are 50% of 2019. Wow. So what is the 2019 retained earnings? So let's see. Can anyone tell me what will be the retained earnings for 2019? Anyone? See, they're giving you a retail earnings of 2.36, right? So 2.36 into 10,000 shares. You're getting a 236, I guess. But is that the retail earnings? They're saying to you 50%, right? The retail earnings for next year's investment are 50% of 2019. So that is 2019. 50% will be 118. So 118 is available as retail earnings here. Okay, I think there's one extra zero. Let me correct that. So 23,600 are you talking about, guys? 23,600, right? So I've just corrected. One student said that there is additional zero I mentioned. So 23,600 into 50% is 11,800. 10,000 into 2.36, 23,600. So the answer, don't worry. Don't worry about the year. Don't worry about the year. Obviously, this question is taken as a snapshot. So don't worry about the year. Some students are saying that the years are updated. It doesn't matter. Just treat this as an independent question. So guys, everyone okay till 11,800 retained earnings? Yes, no? Now my question is, what is my proportion of debentures, preference shares and equity? 3:1:16, guys. That means, can we say easily that equity is 80%? Yes or no? Equity is 80%. And hence, if I look at question number C once more, I said determine the amount that can be spent for capital investment before new ordinary shares must be sold. The answer is not 11,800. The answer will be 11,800 divided by 80%. Now what's that? I think it would be 14,750 is the amount. Till that point, you do not need to go for additional number of shares. Yes or no? I will be explaining to you why I am telling you this is they are telling you that there is a proportion you are following here, right? Capital structure. Because in the first line, they say that this is the optimum capital structure. Optimum capital structure. And they're saying you in the question that determine the amount that can be spent for capital investment before new shares are issued. Where you take money for equity if you're not going for new share, guys? Coming from retained earnings. Retained earnings we just calculated. Year 2019 or whatever the year is, 2.36 into 10,000 is 23,600. 50% is 11,800. Now that only forms 16 upon 20, that is 80% of the total investment that can be spent. Now you can easily say that was 14,750 is total investment. Out of that, I've told you 11,800 is coming from the retained earnings. Where the hell balance 2950 will come from? Where will this balance 2950 will come from? Of course, the proportion we are talking about right now is of debentures, preference shares, and equity shares. So that 3:1:16 would definitely means this is my retained earnings, this is my preference, and this is my debentures. So that means this will come from debentures and preference. Is everyone with me on this? We're talking about debentures and preference. That will have to be issued, but we're not concerned in marginal cost of capital. We are talking about cost of equity. So I hope this concept, this logic is clear to all of you. This is a very good question because this is touching base not only the weighted average cost of capital, but also the marginal cost of capital concept. It's a good question. Quick checkpoints. Great. So point C was very important. Moving ahead, we are now looking at point number D. Now that's the crux. Calculate the marginal cost of capital when the fund exceeds the amount calculated in C, assuming new equity is issued at 20 per share. That means we are saying that investment required is more than 14,750, and hence the retained earnings may not be sufficient. And when I say retained earnings may not be sufficient, that means we say that raise fresh capital. Yes or no? And if I have to raise fresh capital, they're asking us compute the marginal cost of capital. So for calculating the marginal cost of capital, we all understand which of the component will change, guys. That means only cost of equity, new cost of equity will change. Now in that case, they're saying the new issue is at 20 per share. Hence, we are looking at D1 upon P0 plus G. D1 we calculated, I guess, 1.18. P0 is 20 now, and this is 10. So what is the new equity here? I think coming out to be as a 15.9%, right? 15.9%. Okay. Now, once we have the new equity, can we also calculate new WACC because that will be my marginal cost of capital? What will be that, guys? I think we had 8.33 into 3/20. That is same for the debentures. 12 into 1/20. That's same. And then we're looking at a 15.9 into a 16 by 20. So please do a quick checkpoint of this one. 8.33 divided by 20 to 3, we're getting 12. Then you're talking about 15.9. Hence, we are looking at, I believe, as something like 14.57%. 14.57%. So, who said cost of capital is not interesting? What is your say on this? A very, very good question. Different parts, testing you not only on the individual components, testing you on the overall cost of capital, and also the concept of marginal cost of capital is considered here. I hope everyone doing fine till now. Himanshu, yes. See, we are talking about, see, in this case, what's happening, Himanshu, is we're talking about the marginal cost of capital is required, na? And that is why we are doing the new equity. And mind you, we are just saying that, okay, if you are talking about investment larger than 14,750, so you don't know how much fund you need, right? Great. So, okay, so let me quickly go back. On to our illustration here. So I think this is what we have also done. So Bhumika says, okay, Bhumika says interesting and difficult. Okay. So Bhumika, that means hard work will pay off, right? So yes, Dikshita, another way to interpret it. So Dikshita kind of interpreted it as very, very interesting fashion. So the way to look at this could be, yes, we are looking at a 13.85 due to the fact that there is a marginal cost of capital. The WACC increased from 13.85 to 14.57. Great. Okay, so moving ahead, now we are looking at another illustration here, which talks about various information given to us and a lot of parts to be calculated. Let's say the facts here, the company wants to raise additional finance of, that's what, don't worry. Initially, yes, it is a new concept for some of you. Even if it is taking time, don't worry. You will settle in once you redo that example, right? So you understand the concept, redo that example, later on you should be all fine. And that has been the reason I've been extremely slow today. I wanted to cover this example as slow as possible. Okay, company wants to raise additional finance of 5 crore in the next year. The company wants to retain 1 crore earning next year also. And they've given you some details that the amount of, amount will be raised by equity and debt in the ratio of 3:1. Additional issue of equity shares will result in a price being 25. Debt capital raised by the way of term loan will cost 10% for the first 75 lakhs, 12% for the next 50 lakhs. So there are two types of debts here, guys. Interesting. So probably when there are two types of debts, before we will go to the weighted average cost of capital, we might have to calculate the weighted average cost of debt. Interesting. Or we take two proportions, two different debts, right? Net expected dividend on the equity share is 2 per share. And the dividend is expected to grow at the rate of 5% here, guys. You're looking at a 5% in that case. So what do we do? If we are to calculate, one more thing I want to probably clarify here, that the word is net expected dividend. It's not next expected dividend, right? So make sure we do not make that mistake. Now, dividend is expected to grow at 5%, so we probably want to incorporate that if we were to calculate D1. Income tax rate is 25%, and there are requirements, 4 requirements. So question A is to determine the amount of debt and equity for raising additional finance. Now that is your question, guys. You need to tell me what is the amount of equity and debt you will have to raise. So what is the requirement here? 5 crores, right? How much of the debt, how much would be the equity for raising the additional finance? Okay, that's the question. That's what I said. It's a net expected dividend, not the next expected dividend. So probably we are talking about growth rate to be applied on to, right? Okay, my first question is how much equity and how much debt? They gave you a ratio of 3:1. So how do we do? How much equity, how much debt? Amazing. I'm getting a lot of answers as 3 crore or 1 crore. What you have done is, so let me mention on the top, what you are doing is you're saying 5 is the requirement. You're saying 1 crore is a retained earnings, and everyone is telling me 4 crore to be done 3:1. So 3 crore is your equity and debt is 1 crore. That's what everyone is telling me. Guys, but if I talk about debt or equity, debt is 3 crores, sorry, 1 crores. But what will happen to equity, guys? Has anyone thought about that? What will happen to equity? Debt is 1 crore, that's fine. But equity is 3 crore plus 1 because retained earnings is also part of the equity, na? Don't you think we have changed the proportion here? I probably feel that why don't we do one thing? We have said that, okay, equity and debt, and they're giving you 3:1. Apply that ratio to entirely 5 crores. Hence, we say that equity is 3/4 of 5 crores. That is 3.75 crores. And debt will be 1.25 crores. And out of the 3.5 crores, there is a retained earnings available. Hence, the fresh equity, new equity, will be 2.75 and debt will be 1.25. Guys, does this make sense to everyone? Does question number A, the first part of the question, is clear to all of you? Because that's what the key is. Rest is easy peasy. I hope the first part is clear to everyone. Great. So guys, let's do one thing. It's almost 7:20. Before we proceed to the routine stuff, calculating the post, and the last 1 hour will be again more practice and some MCQs. So let's take a 10-minute break, guys. See you on the other side of the break. Okay, so welcome back, everyone. We are back after the much needed break. Let's resume our exercise on this particular question where we had decided the proportion between equity and debt. I hope everyone is clear that, okay, a fresh equity of 2.75 and 1.25 of debt, because we are applying the proportion at a total equity level. Now the next one is determine the post-tax average cost of additional debt. So who will tell me that? Post-tax. And then we are also talking about the cost of retail earnings and cost of equity as well. But let's target B first. So let's see who will answer question number B. Mind you, there may be two types of debt here, right? I can just probably help you a bit. That's the next element actually here. That out of the debt of 1.25, remember, we were looking at first 75 lakhs at 10% and over and above is the next 50 lakhs is at 12%. Now the requirement is post-tax average cost of additional debt. The word is average, guys. Average cost of additional debt. So how do we calculate this then? So my cost of debt will be 10%. So income tax rate is 25. Right. So 25%. So 1 minus 0.25. So 7.5 is 1. That is proportionate of, what is the ratio here? 3:2, right? Plus the next is 12%. Now 12% after 25% of tax benefit seems to be 9, I guess. Right, 9 into 2 by 5. So that would be your average post-tax cost of debt, guys. So I'm already getting some answers. So what is the number we are looking at? Are we looking at 8.1? Some people are giving me 11%, guys. Please check. And I am getting 8.1. Sorry. So 8.1 is I'm getting. Some people are giving me 11. I hope everyone is on the same page. Now, next we move on. If we move on to the next point, determine the cost of retained earnings and cost of equity. So that should also be equals pretty much easy here. I think the information given to us is related to the dividend growth model, right? So what is the cost of equity? Let's see. So we are looking at D1, right? So net expected dividend is 2. So that means D1 is equal to 2 into 1.05. Hence, we are looking at 2 into 1.05 divided by P0. So what's my P0 here? What's the P0? 25. Because they're saying that share price is 25 here plus G. So what's the cost of equity? Guys, come on, you need to respond. I need some answers from everyone. We need to kind of continue that enthusiasm. So no one has given me answer for cost of equity. Why so? So we're looking at 2 plus 5% divided by 25 plus 0.05, I think we should be getting somewhere around 13.4%. Great, now I'm getting some answers, but some people are kind of giving different answers. I think majority of the people are giving me 13.4. I think that matches. And some people are giving me 25. I think just check your calculation, please. 13.4 it seems. So I'm giving everyone a couple of minutes to breathe to check their first section we did before the break. So I think everyone is okay with this particular section. But please double check that you are with me on point number B and C, guys. I hope everyone is okay with weighted average cost of the debt and then the cost of the retained earnings or equity. So now the requirement for the next portion is, okay, someone said, how did you get a 0.05? Okay, because they have given us a growth rate of 5% in point number 4, Varsha. Varsha, that's given here in point number 4 in the question itself. 5% is a growth rate. So you have to know the formula, right? The formula is D1 upon P0 plus G. That's a growth rate. Okay, now the last part of the question was overall weighted average cost of additional finance after tax. I think that is pretty simple now. We need to just know that my equity is 3.75, my debt is 1.25. We know the cost, we just have to multiply the weights. So 13.4 into 3 by 4, 8.1 into 1 by 4, I'm getting a WACC of 12.075. Say don't worry, I think self-study and so if you have missed some part of the lecture, don't worry, self-study and probably after you can look at the session. Next session will be almost 10 days later with me for you guys. That will be on investment decisions. So there I'm not sure whether we can actually take a U-turn because we'll be having 2 sessions where we'll be having to cover the investment decisions. Okay. Question coming in. Bhumika says, can you please repeat the part B? Bhumika, part B is weighted average cost of debt, right? So are you sure that, okay, we are looking at a total debt of 1.25 crores, but that comprises of 2 different debts, 75 lakhs and 50 lakhs? Because Bhumika, in the question itself, if you read point number 3, the debt is available till the level of 75 lakhs, it is available for 10%, but additional debt is expensive. And that actually is a very Bhumika, very practical example. In practical life also, if you increase more and more debt, it will be more costly later on because of the risk attached to it. So there are 2 debts, right? 10% and 12%. And the tax rate is 25%. So net of tax, it will be 7.5 and 9. And that's what we have done here. 7.5 and 9. So that is, basically applied in the ratio of 3:2. So everyone okay with all the parts, guys? So weighted average cost coming at 12.08 with everyone. Please confirm. I think, yeah, great. So we now move on to the set of MCQs here, guys. There are 2 MCQs, and I request you guys to kindly give me the question number with your answer, please. Just mention the question number with your answers. So we have 4. First 2 are on your screen. So question number 1 has 4 options. And in the question number 2, of course, you are more or less computing something. So there are no options over there. So, Hanshu, income tax was given at 25%. Okay, Himanshu, when they are giving you preference shares separately, generally what will happen is the cost of preference share is calculated separately, and that is why we segregate equity, preference, and dividend. I agree with you that equity in a corporate finance balance sheet includes preference stock also. I agree with that aspect. However, when it comes to the usage of the word equity for the purposes of cost of capital, specifically when we are calculating both cost of equity and cost of preference stock separately, there are different models, by the way, because of the different reasoning. Because in preference, dividends have a preference. We will not mix them up. Will not mix them up. We'll use the separate weights, and that's what we have been doing till now. Okay, everyone is giving me question number 1 as option number C. They're saying that which of the following cost of capital requires to adjust tax, and you guys are absolutely correct. It's the interest element that is tax deductible, and hence that is our debentures. Dividends where there is no tax benefit. So question number 1 is C. So question number 2 is more of a computation, guys. Anyone would like to give a WACC quickly for this? A quick WACC computation for this, everyone. So just to help you guys, for question number 2, we're looking at something is given to us, right? So we're talking about cost of capital is given 16%. I think even preference shares is given to us 12%. Is cost of debt given to us? Oh yes, that's also given to us 15%, but hold on. Calculation of cost of debt is post-tax. So 15 into 1 minus T. So would be your 10.5. And rest is history, guys. The rest is history, because now you have 3 costs and you have a proportion here. So if you talk about equity, preference, and I think Himanshu, to your point, this is the classic example, right? The question you raised earlier. The question number 2, you can see 3 different components, 3 different costs. So you are kind of not including with the equity for logical reasons. So talking about a ratio of 50, 15, and 35. And we're looking at 16 here. For preference, we have 12%, and here we have 10.5%. So we apply these weights here, which is like, what's the ratio here? 10:3:7, right? That's the ratio. So what should be the answer? I think some people are telling me 13.48. Some people are telling me 7.9. So 10 by 20 into 16 is 8. 3 by 20 into 12. Are we looking at 1.8 over here? And then we're looking at a 10.5 is more of a 7 by 20 into 10.5. So we're getting 3.675. So if we add them up, we are getting 13.48, right? 13.48, yeah. So guys, I hope the 2 questions are clear to everyone. Now we move on to a couple of more rounds of MCQs, guys. Question number 3 and 4. Three and four. So you need to mention the question number, guys, with your answers. I think question number 3 is very, very good actually. So if you think logically, you should be able to answer. So which of the following is an implicit cost of increasing the proportion of debt of a company? Very, very good question. Some people are saying me A, some people are saying B. I think majority is giving me A, right? PE ratio of the company would increase. I'm really surprised. How can you compute that based on this information, right? If there is a debt increase, price upon earnings, how can we say that, PE ratio would increase based on the given information? Some people are telling me B, tax shield in the interest would be less. On what basis you are saying that? I think, guys, this is a little tricky question, but an interesting one. The correct answer is C actually. Because imagine, when you keep on increasing debt, right? You understand financial leverage, you understand debt to equity ratio. We all learned that debt to equity ratio, financial leverage, right? So more and more debt you add to the organization, it becomes more risky. And if it becomes more risky, the expectation of equity shareholders would be like, more risk, more return. That's the idea. And also it becomes tricky and difficult for the company to get more and more financing as they increase the debt. Guys, everyone clear with me that it is absolutely option number C here. Because in the absence of information, I can't even comment on D also. Return on assets may decrease because you don't know, like, what is the impact on the return if there is any addition in the assets also. So I think majority of you were telling me 3, answer as B, but couple of students like Darshan and I think one more student who selected C. So very good. Is everyone okay with point number C here? Question number 3, just confirm on the query panel. In the meantime, we talk about question number 4 also. Preference dividend per share is 80. Share currently sells for 122 with a flotation cost given to us. So I believe what you guys have done is 18 upon. Have you reduced the flotation cost? So we're looking at 18 upon 122 minus 4. Which looks to be 15.25. I think their majority of you are correct, right? So I think most of you selected, in fact, all of you selected fourth question as option number B. So very good. Good job, guys. Okay, so let's see which question we can target next. Give me a quick second. Okay, I want to just come to the next question here. I'm skipping one question for now. I will come back later. So we'll try to practice a couple of more questions and I will give you a question as a homework. But I want everyone to look at this question of Mogambo Limited. Now we don't want to, we just want to focus on our concepts rather than making Mogambo as happy, right? That's not our objective. So Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings available for investment purposes. For further details, They're saying debt to equity ratio is or mix is 30 to 70. Uh, Cost of debt before tax is given again in two blocks. Up to 180 is 10%, beyond 180 it's 16%. EPS is given as 4, dividend payout is 50%. Expected growth in dividend is 10%. Current market price is given and tax rate is given. I think that's what we need. Thanks for so much of information. And we are saying question number A is to determine the pattern for raising additional finance. I think let me be your guest, guys. You try to compute this. We have discussed this just in the previous examples. What should be the pattern for raising additional finance, both in terms of debt and equity, please? Need your answer. What would be the pattern? How much debt and how much equity first? And then we'll talk about within equity, how much new equity, how much retained earnings. Within debt, how much 10%, how much 16%. 10% I can tell you, 1,80,000. That I can tell you. Okay. Himanshu says, Himanshu, are you sure of that? Double check if by any chance you have swapped your numbers in terms of equity, debt, or debt equity. Omega, absolutely correct. Shubham seems to be a very good answer. I'm very much impressed that many students are taking this initiative, trying to solve option number A here. Okay, yeah, I think now I'm getting this answer. I'm getting this vibe that your guys are absolutely on the track. So guys, what is my debt equity mix? Debt equity mix is 3:7. Hence, we are looking at debt as 3 lakhs. Equity, we are looking at 7 lakhs. Now, out of this equity, we have a retail earning of 2.1, and we are talking about new equity as 4.9. I think this is what majority of you are telling me. Yes, Himanshu. In debt, though, 3 lakhs, we're talking about like 1.8 at the rate of 10%, and probably 1.2 at the rate of 16%. This is what I'm looking for. Pattern for raising the additional finance. Is everyone okay here? If that's the case, can we quickly jump on to solve the part B of the same? Part B of the same. Omega says growth rate is expected growth rate, not normal, like given in previous questions. So said treatment of this growth rate will be different or not. Bhumika, growth rate, we are anyways taking in the context of expected growth, right, in the coming years, based on our previous trends. So I think you are confusing that with the expected dividend versus a dividend, right? So don't worry about that. When we talk about growth rate, growth means growth in future, and that's what it is expected. So I'm going for the next one now. I'm waiting for your answers. First, you need to tell me the average cost of additional debt. I think they've given you the tax also, 50%, right? So we're talking about cost of debt, 10% will be 8% here. And the ratio seems to be 1.8 and 1.2, right? So that means 3:2. So 3 by 5 plus, okay, sorry. So initial is 10%, right? The first one is 10%. So 10% into 50. So we will use probably 5% cost of debt for the first 1,80,000. And the next 1,20,000 is 8%. That's what we'll do. I hope this is making sense to everyone. What is the amount we should get here? 3 plus 3.2, right? 6.2%. So a couple of people are getting different answers. Please check. I think 6.2 looks good to me. Majority of you anyways told me that. 6.2. And then we talk about cost of equity and cost of retained earnings. Of course, in this case, you can calculate the same. In this case, the D1 is, so dividend payout is 50%. So if 4 is my EPS, probably we know that, okay, the D1 will be like dividend is 50% into 4, that is dividend is 2. Mind you, my expected growth in dividend is 10%. So D1 upon P0 plus G means 2.2. And what's my P, guys? 44 plus 10%. So I believe we should be getting cost of equity as 15%. You answer the question that dividend payout is given to us on face value of payout. So Himanshu, dividend payout would be on what? What? It is on EPS now. Out of the earnings, how much you are paying as a dividend? Out of the earnings, how much you are paying as a dividend, right? That's what the call is. So is everyone getting these answers right now? Cost of debt, cost of equity, 15%. And if you have got the answers, please calculate overall weighted average after tax cost. So what would be your overall weighted average after tax cost? So basically, we are now talking about WACC. So what is my ratio? Debt is equal to 3:7. So 3 by 10 into 6.2 plus it over 15 into 7 by 10. So are we getting 12.36% here? Where's Darshan? We don't have any information on the any kind of a existing equity, so we're talking about the new equity itself. So that means the new financing and the basis is your current market price only. We don't have any flotation cost, nothing. So don't worry about that. I can get a couple of answers I can see coming as 12.36. I'm just waiting for others to respond. Great. Now you can see Sudhanshu, Hiraz, Bhumika, everyone is giving me this answer. Great. So you guys can double check. I'm sure everyone is okay with this. Just giving everyone one more minute. Post tax. Okay, Bhumika says post average tax is confusing. Why so? Why do you say so? So what's happening here is, give me a quick second. So Bhumika, the post tax average tax here we are talking about. First, we need to ensure the debt part, right? So 3 lakhs was divided into two, 1.8 at 10%, 1.2 at 16. Now that interest is not a cost of debt. Cost of debt is interest net of tax. So 10% into 1 minus 5, 1 minus 0.5, and then 1.2 at the rate of 16% into 1 minus 0.5. Right? So we're looking at from that perspective, cost of debt 1.8 at 10% into 1 minus t, 1.2 at the rate of 16% into 1 minus t, right? So that part we have to do and multiply that with the weightage of 3:2. So Bhumika, just apply that weight first at the cost of debt and then normal WACC because your weightage is given 3:7. There is no confusion in that. Okay, with that, we move on to the next question here, which you can see on my screen. So let's quickly go through that as well. ABC Limited has the following book value capital structure. Equity share capital 1000, so these numbers are in lakhs. Reserves and surplus. We are also talking about 9% preference shares. And just look at like how much shares are in the brackets, like 5 lakh shares, 1 crore shares, 8.5% debentures, and 12% term loans. Now, here also we are talking about two types of debt here, right? One is 8.5% debentures and 12% term loans. Then we are saying debentures are redeemable at par after 5 years and are quoting at 985 here. And the current market price per equity share is 60. Prevailing default risk-free rate on a 10-year treasury bonds is 5.5. I'm very much interested in seeing that they've given you average market risk premium as 7%. And the beta is 1.85. Preference share of the company at 10%, redeemable at 10% premium, is currently selling at 102. And what they've given us a tax rate also, what do they expect from us? Weighted average cost of company using market value weights. Wow. Market value weights. Now, what do we do here, guys? What should be our first step before we even go for cost of capital weighted average? Do you all agree that we need to go for individual components? Of course. I hope everyone is okay. We should do that. Hence, can we calculate a cost of debt first using the formula we know? They're talking about redeemable at par after 5 years. And they're not talking about YTM method here, I guess. So what will be the cost of debt? Okay, let's see. What is the cost of debt, guys, using the same formula? Let's see who will answer this. So I'm already getting some answers. We're saying 9 point something something. So what are we doing here, guys? My debenture is 8.5%. So that means 8.5% into 1000. You're looking at 85 is my interest. Of course, it is our net of taxes 1 minus 0.35. And mind you, then we're talking about redemption value also, right? So redemption value minus whatever you are talking about, the current market price also, right? Redemption value is redeemable at par after 5 years, currently quoting at 985. So can we say 1000 minus 985 over the life of these debentures, 5 years? And in the denominator, we have average of the two, 1000 plus 985 divided by 2, 992.5. So this is the average number. Hence, what is our answer, guys? I think I'm getting 5.87%. Himanshu, is it sure that you're not missing out anything or I'm missing out anything? Your number and my number looks pretty similar but not same, right? I'm getting 5.87%. Guys, anyone please check cost of debt here? I think probably straight away we can also calculate, like debenture is okay. We can also calculate the financial loans, right? So cost of long-term loans. So that is debt only, debt in terms of loans. What will be that? 12%, right? So 12 into 1 minus 0.35, 7.8%. That is pretty straightforward one, 7.8. Varsha says, how did I get 992.5? Varsha, in the denominator, we have redemption value plus net proceeds upon 2. I just explained that. Hence, 1000 plus 985 upon 2. That's how I arrived at 992.5. So I think cost of debt is clear to all of you. Cost of long-term loan also is clear. I'm just waiting for a minute so that everyone else can confirm this, please. Bashar, can you check long-term loan? I think I'm getting 7.8, 12 into 1 minus 0.35. Okay, I think similar to the debt for the redeemable preference shares, guys. Who will tell me? Cost of preference shares. They're giving you redeemable at 10% premium and currently is 102. Amazing. So 100 ka share redeemable at 10% premium, that is 110. So 9%, right? So 9, there is no tax benefit here, or if it is there, let me know, please. 110 minus 102 divided by 5. And then in the denominator 110 plus 102 divided by 2. That's how you calculate, right? So what is cost of preference shares here? I think interestingly, I'm getting exactly 10% here. Exactly 10%. Okay, I can see some responses, 10%. That's in 7.8, right? Not 7.32. 7.8, I guess. I hope everyone is done with cost of debentures, cost of preference shares, and cost of long-term loans. If these three elements are done, and those of you have done the three elements, can you calculate and confirm what will be the cost of equity? Which method do we use here? Which method do we use and what will be the cost? Himanshu, perfect. Got one answer already, but I want to give everyone else also the time. So Darshan says yes, it will be using CAPM. It says RF plus beta into RA minus RF. My question to everyone is, RF is given 10-year GOI bonds of 5.5. Beta is given 1.85. For the average market risk premium, should I do 7 minus 5.5? Should I do this? This is my question to everyone. Should I calculate like this, or is there a problem here? Is there a problem in this approach? Or can I calculate using this formula? Harshita is like, no, absolutely no way you can do that. Harshita is saying like, don't try to fool us, right? Himanshu says no, it's already given. Guys, this is what I was talking about on Wednesday, right? That giving you the market risk premium. So already RM minus RF is given now. So don't do this. 7 minus 5.5, don't do this, please. Make sure you understand the requirement. They've told you that market risk premium is 7, so RM minus RF is given to you. As simple as that. So that means you have to just multiply that by 7%. So 1.85 into 7%. So we are getting at 18.45. And then amazingly, all of you have given me the answer correct. Amazing guys. I received almost 6 to 7 answers and everyone had given me 18.45. Very good. And that means one thing's for sure, between the 2 days, you have learned your cost of capital and ensure that you lower down your cost. That's a very, very good aspect. But the game is not over yet. The requirement is calculate the weighted average cost of capital using market value weights. You know the individual component now, but you have to calculate or probably see what will be the market value here. What will be the market value? For example, what will be the market value for, let's say, equity? I think they're given you the market value of the equity here in the first line on this point. The current market price is 60 here. So what is the market price? What's the market value here? So are we looking at 60 crores? So 1 crore shares. So 1 crore into 60. Or can we say if you want to pick up in lakhs, probably 6,000. You guys agree on this? 6,000 is the equity market value. And mind you, equity market value is 6,000, very good. But does that include equity and retained earnings both, or only equity? Does that include both retained earnings and equity share capital, or it is only talking about equity share capital? That's my question. I already answered that in today's class though. So let's see your response. What does it include? Himanshu says it must be appropriate. It must be appropriated in reserve and surplus. Okay. Now in this case, Himanshu, as I said earlier, so you guys are absolutely correct that yes, it includes retained earnings. Now whether you proportionate into retained earnings or equity separate, based on the book value, or you don't do it, it's one and the same thing. The reason is you do not have a separate cost of equity and retained earnings. Cost of retained earnings is equal to cost of equity, and hence it will not matter. If the cost of equity and retained earnings were different, then you would have appropriated this market value 6,000 lakhs between 1,000 and 2250 ratio, guys. I hope everyone is with me on this. So it's important that we understand this logic, that this ratio will be used to allocate that 6,000 into the equity share capital and retained earnings, right? However, in this case, since it's just one cost of equity, it doesn't matter. Great. What is the market value of preference shares? I think that also were given 102. So market value of the preference shares 102 into 5 lakhs. We're talking about 510. 510. And the debentures are quoting at 985. So probably there we are looking at 985 into 1.5. So we're looking at 1477.5 in lakhs. Makes sense to everyone? So if you understand these market values, I think what we need to do is just simply, we need to just plot these market values here. Equity, 6,000 in lakhs, preference, debentures, and the term loans will remain the same, right? Term loans is 500 lakhs. There is no separate market value for that. So that we need that weightage. What is the proportion of the total of 8487.5 for each of the components? So we talk about 6,000 divided by 8487. It will give you to 70.7% and so on. And every component is just multiplied with the cost of capital we calculated. Now, interestingly, what I was talking about, guys, if you wanted to allocate, or rather apportion, 6,000 you want to split into the share capital and retained earnings, the proportion will be the same. Proportion will be the same. That is, whatever the book value is the proportionate here. That's given to you is 1,000 and 2250. Right? And 2250. The only point is whatever you get here. So for example, I'm getting, let's say, 1846 here, for example, and we're getting 4154 in this case. So if you divide that, if you would have allocated that, would have really make any difference here? Because this is again, this is in the same proportion, but what we are getting is actually a 6,000, and cost of equity would have been anyways be using 18.45. Yes or no? Guys, are you getting me? Even if you have divided, 18.45 would have been given a same weightage out of 8487. 6,000 remains same out of 8487. had the cost of retained earnings and equity be different, then it would have made sense. Like we did an illustration earlier, a smaller illustration earlier. Has everyone with me on this? What I'm trying to say here is that it would not have mattered. Any questions, please let me know. Please let me know, guys. Great. So if everything is clear, guys, that's an amazing kind of participation, I would say. Now, we are just left with one particular question, and I want to intentionally give you this as a homework, although just kind of quickly tell you how to approach this question. You have a solution with you, but I want you to try that later on your own. So this question is based on Navya Corporation having a capital structure of 40% debt and 60% equity. I'm just giving you a brief overview of this question, and this is a homework for all of you. The company is presently considering several alternative investment proposals costing less than 20 lakhs. Corporation always raises the required funds without disturbing, this is key part, without disturbing its present debt equity ratio. And they're giving you cost of debt and equity. And can you see that higher you go, the cost of debt increases, and so is the cost of equity. Pretty logic. And they're saying that you have to calculate the cost of capital of two projects X and Y, whose fund requirement is 6.5 and 14 lakhs respectively. So I think 6.5 lakhs fall under this project X, and 14 lakhs fall under the next table. Guys, do you agree with me on that note? All okay? So we're talking about third and fourth range here. So we need to calculate the cost of debt and equity for third and fourth range specifically. Now, the only thing is, if you see the second part, if a project is expected to give after tax return of 10%, determine under what conditions it would be acceptable. So we talk about under 10%. Now, in that case, probably we need to know the cost of capital of all the ranges. If you're saying that a project is expected to give after tax return of 10%, do you agree with me? You will accept that only when the cost of capital is either 10 or less than 10. You don't want to go for a loss over there. Do you guys agree with me? Yes or no? You will never go for a loss, right? So if you're saying that, okay, if the project is expected to give after tax return of 10%, you have to just ensure under what conditions it will be acceptable where your cost of capital will be less than equal to 10%. And for that, I would need a cost of capital under each of the scenarios. And it is not a rocket science. We know the proportions, we know the cost given to us, and we know the weights. Interestingly, 40% debt, 60% equity. That's amazing, guys. Do you really need to do something here? No, we just need to calculate project cost. We need to know the after-tax cost of debt, right? So the cost of debt is given to you. The only thing is just make sure that 50% tax rate is taken. So we calculate the after-tax cost of debt. Cost of equity is given. You need to calculate the WACC for that ratio of 4:6, and hence you can easily allocate. What is the cost of capital for project X? What is the cost of capital for project Y? And in the which scenario you can actually go for your 10% return. So I think that's it is. That's it. So basically you should calculate the cost of capital. I just answered that for all the four scenarios, and then you can use that information in subpart 1 and 2. Right, great guys. So I think that brings us to the end of our session on cost of capital. I would say the series of 2 sessions. So that is pretty amazing, guys. I would like to thank you all. I think you were literally an amazing audience and students who are doing your hard work. I can see that from the queries. The kind of efforts, the kind of participation you guys are showing in. I'm sure that will continue to flow in the upcoming sessions. So and just I request you guys, whatever we have discussed in these 2 sessions between today and day before yesterday, please ensure that you guys read everything, read your book, do your practice from your study material, and also pass your questions. That's very, very important because it's fresh in your mind, whatever we have discussed. I'm sure you try to do a variety of questions so that it gets cemented. And then we will be catching you guys almost, I think, from here, almost 2 weeks, maybe around 12th May, we might be meeting for investment decisions. So 2 weeks from here. And I will be looking forward for that session, guys, capital budgeting. And mind you, by then, I would be expecting that you guys know cost of capital, right? Because you want to ensure that the limited capital has to be apportioned between the different projects based on certain evaluation techniques. We'll be talking about discounted techniques. We're talking about non-discounting techniques. So a lot of fun we will have. I'm sure you guys will also enjoy that journey. So we will be meeting again in a couple of weeks' time, guys. So God bless you all. Happy learning. Make sure that you continue your hard work. Remember the 3 golden, tricks of success: practice, practice, and practice. So with this thought, I take your leave, guys. Have a very good evening and best of luck for your studies and your other curriculums. Take care. Bye. Cheers.